Hello, everyone. I'm Denise Quinn from Mid-Hudson Valley Federal Credit Union. I'm a loan originator, and this with me is Catherine DeClerc.
Hi, everybody. I'm Catherine DeClerc. I'm with Howard Hanna Rand Realty. Thanks for joining us tonight for this first-time homebuyer seminar.
We are going to be recording this seminar, just so you all know, so you could get a copy of it sent to you if you would like. Anyway, we're going to start our first-time homebuyer seminar, Your Journey to Home Ownership.
So much for the technology working well. There we go. Sorry.
Okay. So what we're going to discuss, the path to your home ownership, how much of a house can you afford, your credit score and your credit report, the application criteria, the types of mortgages that are available, the components of a mortgage loan, the homebuyer programs, and then the fun part, which is searching for your home. I think we gotta go back one more.
There we go.
We're new at this, so be patient with us.
I'm going to blame it on Mercury still being retrograde.
Okay, so buying your first home. Buying your first home is one of the most exciting purchases of your life. It's also one of the biggest purchases of your life, so it can be very nerve-wracking. It's the most important financial decision you'll make, and you need to take the time and review everything and make the most financially sound decision for you and your family. You want to figure out what you can afford a month to pay, because you don't, sometimes you think, well, I can afford $3,000, but right now I'm only paying $1,000 and I have nothing in savings. So if you think you can afford $3,000 and you're only paying $1,000, you should be putting an extra $2,000 a month into that savings account, so you know what it feels like to actually make that payment. You also need to keep in mind, when you're, to save money, because when you own a house, it's not like when you rent a house. When you rent a house, the landlord comes and fixes the house when there's a problem. When you own it, you do have to make the repairs. So calculating what you can afford, there's different components that go into, getting a mortgage. There's various costs with buying a house. You need your down payment, your closing costs, your post-purchase funds, which, moving costs. Then you need a year of property taxes. And then, when you move in the house, or once you own the house, if you want to paint or maybe do some upgrades, you need extra money for that also. Now, with regards to the credit and home buying, it's very important to know what's on your credit. You can access your credit report by going to annualcreditreport.com. It's a free site the federal government set up. So once a year, you go in there and you go into each of the credit reporting agencies, Equifax, Experian, and TransUnion, and you look what's on your report, and you have the option of disputing any of the things that you aren't correct. And it also allows you to check and see if there's any fraud on your account. Credit and home buying. As a lender, we do rely on the credit score, and the credit score goes into different facets of your approval. So the higher your score, the lower the risk to the lender, which also equates to lower PMI for you if you don't put 20% down, and also lower closing costs when your score is higher. And as a lender, we do pull from all three credit reporting agencies, and we go by whichever score is the middle, and that is the score that's going to determine all of those things for you. Your credit score is made up of different components to calculate, how they come up with your score. 30% is the amount you owe. 35% is your payment history. 15% is the length of your credit history. 10% is new credit, and also another 10% is a mix of credit. So it's good to have installment loans and revolving credit, because all of those items make up your credit score. So to improve your credit, you want to make sure your debt's paid down as much as possible. You also want to make sure you pay everything on time. Avoid balance transfers if you're opening a new card. Try not to open any new accounts before you're ready to buy a house, because that does have a negative impact on your score. Another thing that has a negative impact on your score is if you close old accounts. So say you have a credit card that you've had for 10 years and you pay it off, don't close it, because that would be a negative impact on your score. And again, review your credit report annually. So applying for a mortgage. The following is considered when you apply for an application: your credit score, how much you have for your down payment, your employment history and your income, and your debts. Another thing that is included in when you apply for a mortgage is the amount of reserves that you have left after you have to pay for your down payment and your closing costs. So the more reserves you have, even if it's a 401k or a different type of retirement account, that is a plus for you when you apply for a mortgage. So you will want to get a pre-approval, after you check out your credit report. When you go onto annualcreditreport.com, it's not a pull on your credit, so it doesn't hit your credit score. And I tell everybody, they offer you an option of paying to get your score. Don't do it, because any loan you go for has a different model for scoring your credit. So if you came into the credit union and I pulled your credit for a mortgage, and then one of the MSRs pulled your credit for a car loan, and another one pulled it for a credit card, we'd all have different scores for you, because there's different models for scoring your credit depending on what type of loan you're going to get. So with your pre-approval, we pull your credit, I always ask for pay stubs and W-2s or tax returns if you're self-employed. And the pre-approvals are typically good between 60 and 90 days. So the mortgage process, once you find the house, you do need your pre-approval to go out shopping. And then once you find the house, you're going to want to start your application. Your application, that's when you're going to find out, that's when you can lock into your interest rate, and you'll find out what the APR is and what origination fees you'll have. We'll also do a credit check if your credit has expired from when your pre-approval was done. And then, they'll give you the exact closing costs also. And after all of that's put together and your loan is submitted, it goes to processing, and then the processor will order the appraisal and gather some more documents, and then it goes to the underwriter, and the underwriter does the actual written commitment. And a lot of times the underwriter does have additional conditions that they want for your loan approval. And once you get all of those conditions together, your file ends up being clear to close, and then they can schedule you for your closing date. It sounds like a really easy process, but a lot of these items take a little longer than, a week. And, Catherine will tell you, it's very important, especially in this market, to get a pre-approval. So the types of mortgages that are out there are fixed rate mortgages, adjustable rate mortgages, VA loans, FHA loans, and Fannie Mae loans. Today we're going to focus on the components of a mortgage, which is your principal, which is the amount of money you borrow, then the interest, which is what you pay every month to pay back that money along with the principal. And in the beginning of your loan, more of your payment goes towards interest than what goes towards principal. So in the beginning of the loan, if you have extra money to pay, it has much more of an impact in paying your loan down quicker than, when you're further into the loan, like say 15 or 20 years into the loan. Then you also have your property taxes, which are included in your monthly mortgage payment, your homeowner's insurance, and mortgage insurance. And mortgage insurance you pay to the lender if you don't put 20% down. So the homebuyer programs that we're going to discuss today is the Fannie Mae loan, which also has the down payment assistance loan. Then the Homebuyer Dream program, the Fannie Mae Home Ready, the Fannie Mae Neighborhood Revitalization Loan, Fannie Mae 3% down program, and our portfolio first-time homebuyer loan, which is our helper loan. The Fannie Mae with the DPAL, this gives a grant of up to 3% of the purchase price. That amount is forgiven over 10 years. So each year, 1/10 of that amount comes off. There are income qualifications for a Fannie Mae loan. It is a first-time homebuyer loan. So you do have to be a first-time homebuyer. The income limits for Orange County are, let's see if I can read it. Orange County, for the Achieving the Dream loan, which is their lowest interest rate, for a family of 1 or 2 is $80,400, and for a family of 3 or more is $92,460. Now, Fannie Mae also has the DPAL Plus, which is a grant of $30,000, but you have to be at 60% of the income adjusted median income limit. So for Orange County, for a family of 1 or 2, that is $60,300, and for a family of 3 or more, it's $69,340. So if you're under that income limit as a family, you could qualify for a $30,000 grant that they will give you, which is forgiven over 10 years also. So that's a really good program for buyers that are eligible for it. There is a limited amount of funds for that program. I think I just surprised Catherine because she didn't know about that.
30,000 is a lot of money.
So then there's another grant. It's called the Homebuyer Dream Grant, and this provides up to $9,500 towards your down payment or your closing costs. And this grant can be combined with either the Fannie Mae regular DPAL or the DPAL Plus, or if sometimes some of the housing counseling agencies have grants also. You do have to take a first-time homebuyer education course, and you have to have a fully executed contract to sale to be able to apply for the Homebuyer Dream program. And these funds also are a limited amount of funds, and they usually become available in May each year. And this year, the grant ends November 1st. And there are income qualifications for this, and you have to be a first-time homebuyer.
Can I ask a question about the $30,000? Because I'm still thinking about that one.
Sure.
What can you use that for? That's a down payment assistance grant, so it's strictly for down payment? Would it
down payment and closing costs?
And closing costs.
So the borrower just has to have 1% of their own funds for the transaction. So if the house is $250,000, the borrower just has to have $2,500. All the rest can be paid by the grant.
Which means no closing costs, basically. It could cover all the closing costs.
Correct.
That's great. Now it doesn't affect appraisals or anything.
Correct.
That's a good deal.
Then we also have the Home Ready program, which is another 3% down loan. You do not have to be a first-time home buyer for this loan. You just cannot own a house when you close on this loan. And you can have a non-occupying co-borrower if you put 5% down. So if you don't have enough income and you have a mother or father or brother or sister, someone who's willing to co-sign for you to help you qualify for the house that you want to buy, you're allowed to do that with this program. There are income qualifications for the buyer. So there is a max income for this loan. And then Fannie Mae has another 3% down loan. And unlike this loan, there are no income restrictions, but you have to be a first-time home buyer to be able to do the Fannie Mae 3% down loan.
Does a first-time home buyer mean they've never owned a home or just not for a period of time recently?
That's a great question, Catherine.
Thank you.
You just cannot have owned a home in the last 3 years. If you
Okay.
haven't owned a house in the last 3 years, then you are considered a first-time home buyer again.
I know the screen will change eventually.
She is pressing the
I'm
button.
pressing the button. It's not moving. Oh, then it moves twice.
So I'm going to go with the helper loan. That is our first-time home buyer loan that we do at the credit union. It's one of our portfolio loans. Again, it's a 3% down first-time home buyer loan, which has income limits. And like every other first-time home buyer loan, the income limits vary depending on the county you live in. However, with this first-time home buyer loan, we will only do it on single-family houses. We won't do it on condos or mobile homes or anything like that. And you must be a first-time home buyer.
So with the single family, could it be a multifamily? Can it be a two-family?
No, not for ours. But any of the other first-time home buyer loans, you can do a multifamily. It's just with our own first-time home buyer loan, we limit it to the single-family residential homes.
Okay. Good
Now
to
it's
know.
Catherine's turn.
You'll be responsible for it. Now I keep clicking the button. There we go. So finding the home. First question is, do you need a real estate agent? Of course, I would say yes, you do. We do more than open the door. We do more than find the home. In most cases, a lot of our buyers find the homes themselves because they're online looking like all day, it seems like. Every time something new comes on, you know, I get messages from my buyers interested in seeing those properties. So what the real estate agent does is a lot more than show you the home. They facilitate a very complicated process, and they typically work in like a team approach with a lender to help make it go as smoothly as they possibly can. So having that coordination is really important, and I think that's where a lot of times we overlook it. And as Denise said, it's, you know, you might think from what you saw, it's simple, but it tends to be longer and a little more complicated than what we might expect. When you're looking for a real estate agent, shop around, you know, find someone whose personality fits your style. Talk to them about their availability. Are they available on whatever schedule you're available? You know, do they work weekends? Can they show you properties at night? You know, how will they communicate with you? Are you going to see the listings, you know, as soon as they come on the market? You may have heard we're in a crazy hot seller's market right now. So that means buyers are competing with many other buyers, and you need an agent that's going to be available to pounce as soon as something comes on. You want to think about what you want, what's important. You're going to have needs, wants, and wishes. You know, your needs might be, I need 3 bedrooms, you know, and you might want, you know, a brand new designer kitchen, or maybe that might even be a wish. So know what the things are that you must have, and then some of the things that you would be flexible on. And if you have a partner, sometimes, you know, the partner's needs and wants are different. So if there's 2 of you, make sure, you know, you talk about it and you know what you're willing to trade off and how important some things are. Sometimes I suggest make a list separately and then come back and say, oh, I didn't realize the garage was so important, or, you know, the basement. So make sure you've got kind of that fleshed out, because it'll become a frustrating process when you start looking, because everybody's expectations might be a little bit different. Oftentimes there are things included in the sale. The most common things are, you know, the stove, the dishwasher, but sometimes homeowners take their refrigerator. That sometimes, not all the time. The things that sellers are most likely to take tend to be the washer and dryer. So if that's the case, when you're looking at the properties, know what's included and what's not, so you can plan in your budget if you're going to need to purchase a washer and dryer, for example. Sometimes homeowners want to take other things like light fixtures, or, you know, might have some sentimental attachment. So you want to be careful when you look at a listing, because some of those items, like a refrigerator, you know, are a big ticket item. there will be contingencies in your offer. And a contingency is something like a home inspection. That's saying my offer is contingent upon the home inspection going okay and being happy with what the home inspector finds. There'll be contingencies. There's always a contingency for an attorney review. When you meet in our area with a real estate agent, they don't prepare the contract. They make an offer. Sometimes you hear it called a binder or a purchase offer. That's the template that the attorney is going to use to draft the contract, but it's a simple version of it. So an attorney review, of course, is part of that process. There will be other things like a mortgage contingency, and that's saying if I don't get my mortgage, I get my deposit back. That reasons that you might not get your mortgage, maybe you lose your job or something like that, or your spouse passes away during this process and now you don't have the income. So those would be a mortgage contingency is an important piece. You have to make a good faith effort to get your mortgage, but if you're declined for some reason, then you would get your deposit back. And I'm sure you can imagine that home sellers don't want that to happen. And that's why the quality of the pre-approval is so important. The homeowners care about, well, I guess they probably more, the agents may be more aware of the banks that close their loans and have a good track record, like Mid-Hudson Valley Federal Credit Union. So when I present an offer and that's the lender that I'm using, the other agents know that this person has been well pre-approved and is going to be able to qualify for the loan barring some catastrophe. So it's important who you select. And then you go ahead and you make your offer, and that's the piece that the agent will walk you through, of course, those steps.
Wait, one other contingency I think we should talk about though is the appraisal.
Oh,
yes.
Thank you for reminding me on that. So an appraisal contingency means that the property needs to appraise by a certified appraiser for the amount that the buyer is paying for it. And so let's say you're purchasing a $250,000 home. The bank will order the appraisal after you do your application. The appraiser's independent and goes out and does a valuation of that home. If it appraises for $250,000, that's great. If it appraises for more, that's fine too. If it appraises for less, though, that's going to create a problem. If you need to have, say, for whatever loan you're doing, let's say you're doing 3% down, the 3% down of the amount that it appraises for. So if it appraises for less, you're going to get 3% of a lesser amount, which would mean you'd have to put more cash into the transaction. It's somewhat of a safety measure for the bank and really also for you, because if you make an offer and you're worried, say that you're overpaying, because sometimes I hear that in a hot market where there's bidding wars going on, the appraisal will be the part that saves you from that, because if it doesn't appraise, then you would not have to go forward with the transaction. The issue, though, I will say in this market is that you will compete with other buyers, absolutely, and they may have larger down payments, and then they don't have to worry so much about the appraisal. And we hear, and if you're looking up, how to buy a home online, you hear all sorts of things like waiving an appraisal contingency. I think there's a lot of confusion about that. People say, I'm just going to waive it. The bank's still going to appraise it. It's not like you're going to say, oh, I don't need that. What you're saying is, I'm going to waive sort of the ramifications of it. And if it doesn't appraise for the full amount, I'm okay. If that's the case, you need to have that extra cash and probably be able to show the listing agent that you have it. So in case that happens, you're going to be able to move forward. Because it's really not about you and the seller, it's about the seller selecting the best offer out of all the offers.
Yes.
Anything else you want to add on that?
Okay. That was good.
So finding a home. Real estate agent services are free to the buyer. That's the nice thing. You really want a buyer's agent, especially when you're a first-time home buyer. A buyer's agent works for you, but most cases, like 99% of the time, they're paid for by the seller. So you get the agent's services basically for free. It's actually really built into the price of the home. So choose the realtor that's right for you. As I said, select someone that's the right personality and style, that's going to match with you, that you feel comfortable with. The real estate agent should be well versed in the areas where you're searching and the property type that you're looking for. So if you're looking for a multifamily or you're looking for a condo, you want to be sure you have someone who has experience in that area.
And you do want an experienced agent because they know how to negotiate for you. And that's very important, especially in this market.
Yeah, in this market, you need an agent that's going to be able to advise you on pricing. That would be the first thing. What a home like this would be selling for, because sometimes people are surprised. You know, you may hear in the news they're going over asking price. They're going 5 or 10% over. 10% of a $250,000 house is another $25,000. I mean, 10% is a big chunk. Sometimes people are surprised by that, and you may lose out when you bid. You know, you might bid on 1, 2, 3, 4 homes before you really find, you know, the price point and fully understand that. And a good agent's going to be able to help you with that. So shopping for homes, this is the fun part. Once you know what you can afford, then you can start taking a look at the homes that meet that criteria that you talked about. Having that pre-approval up front is so critical. Most agents will not take you out without it. And think about it this way. It's very frustrating if you go and you look for a home and then you find out after the fact, after you fall in love, that it's really not the price range you want to be in. And then some people never really recover from that. So make sure you start in the right price range. I was having a conversation with someone today who said to me, well, we're qualified for this amount, but we don't really feel comfortable paying that much per month. And that's very common. So make sure you know what the monthly payment is for the price range that you're looking in, because you don't want to have to then, you know, change after you start looking at homes.
And a lot of sellers don't want people in their house if they're not pre-approved.
Right. A lot of them require a pre-approval just to make the appointment. So, and it's a good business practice for the agent to make sure everybody's pre-approved before they go. You know, you remember they're working on commission. They don't get paid unless the transaction closes. So they should be checking to make sure. And it's really for your own, you know, safety as well. So you'll probably be looking at listings online. Oftentimes people start looking before they even contact a real estate agent. You know, you might be browsing. So again, I wouldn't say just pick any agent or click the button. You know, read their bios, find out about them, and make sure you're working with somebody who's experienced with, especially first-time home buyers. First-time home buyers require a lot more hand-holding because you haven't done it before. So make sure you've got somebody who can give you that time. Some agents might be really super busy and they may have too many clients to work with and then not able to give you the time that you deserve. This is one of the biggest purchases of your life. So you want to be sure you're with the right agent. So make a list of the items that you must have in the home. I mentioned that before, you know, maybe the number of bedrooms or square footage. Wherever you're living now will give you some idea of the square footage that you currently have, so you can picture what the square footage is that you're going to really need, whether it has a basement or not. Sometimes, you know, maybe you might need a garage. And of course, oftentimes what's really of value to any buyer is the school district. So do your homework on all the different school districts and know all about them, so which ones are appropriate for you. Sometimes people ask me what's the best school district, and honestly, I could probably put 10 people in a room and give them the same school reports and they come up with different answers. So it depends on, do you want a large one or a small one? What kind of Activities do they need to have? So do your homework on the school district, especially if you have children, so you know it's the right one for you. And one other thing about the school district, you know, a lot of times people think I want to move in the summer so I don't disrupt the kids, because if you're renting and let's say you're staying in the same school district your kids are already in, it makes it a little harder to find a home if you can only shop for a home at a certain period of time. You know, most homeowners aren't going to, you know, let's say you see a house in October and hold it for you until June. So I always tell buyers to think about it this way. Kids are resilient, and especially little kids, they have friends by lunch. So don't worry about the time of year, because in the summer, it's often hard to find the other kids in that area. And when you change a child during the school year, then they meet the kids right away and they're thrown into activities. Some kids might agonize all summer about the start of school. So they can adjust. Maybe not your junior, senior in high school, but you know, kids that are younger tend to move between school districts pretty easy when they're younger. So did we do this one right? Yeah.
We didn't, but we talked about it.
Yeah, I was gonna say, I think we talked about this. So a couple other things on here that we didn't mention. Another contingency, the sale of a previous home. This is a first-time homebuyer seminar, so chances are you probably don't have another home, but sometimes people, you know, might be here who do. And if you need to sell your home to purchase a new home, you want to get that home sold first. A lot of times people don't want to do that because they don't want to have to move twice. But it is truly a weak negotiating position to be in on the sale and on the purchase. You're trying to do both at the same time, so you're kind of desperate for the buyer when you do find the house that you want, so you may not get the best price there, and you may have to overbid on the purchase to get a seller to want to put up with the house sale contingency. So it's a weak negotiating position on both ends. It's most likely not worth it in what you're going to save on the inconvenience of moving twice. So you'll talk to your real estate agent about that, but best to list it and sell it, because you're competing with buyers, you know, who don't have something to sell. So an important piece to get out of the way.
And sometimes the buyer has a contingency for them to find another house, which is not listed on here.
So, and if there's this stacked dominoes, you know, now the house that you want to buy, that homeowner's not just worried about you getting a mortgage, but they're worried about your buyer getting a mortgage and their buyer getting a mortgage. And so your offer's most likely not going to be accepted. So get that piece done, take advantage of where the market is right now. You might put most of your stuff into storage and look for a short-term rental. Then you get to, you know, you get to shop for whatever you want on your time frame, and you're not going to feel rushed in a market that has very low inventory.
Correct.
That's a lot of stress to buy and sell like that. Okay, so you're ready to make an offer, and your offer has 3 components to it, at least. So we have the purchase price, we have the closing date, and how long the offer is good for. So your purchase price would be whatever you're offering. That may be just a starting point, and you may negotiate back and forth. With the seller, they might ask in this market for your top offer. They may call it highest and best or best and final, in which case you've got to put forth the top number that you'd be willing to pay and still feel good about it. There's some other strategies. I don't want to get too deep into it, but there's some other ways to handle this bidding type situation, and your agent would be able to walk you through. One thing that's not on here, though, is the amount of your deposit, and that's an important piece and a consideration that the seller will have. How much money are you putting down into escrow when you sign the contract? The more, obviously, the better. That's the amount you're willing to risk if you just change your mind. So you can imagine the seller's looking for the most that you can at that point. Sometimes you might put, let's say you're doing, let's say you're doing 10% down. You might put the whole 10% down on the contract, or you might just do 5%, in which case you bring the other 5% to the closing. So the amount that goes into escrow may be your entire down payment, or it might just be a portion of it. You're going to estimate what the closing date is, and typically it's taking a good 60 days. Good, could be longer, could be 75, from the point at which you make the offer until you close. So in this period of time, you do a home inspection, attorneys prepare contracts, and that takes a few weeks sometimes to get that all done, and the bank isn't going to do anything until you have that contract. So however long that takes affects the start of everything else. There's a lot of other things that extend the period that have nothing to do really with the bank. Things like ordering a survey, or the municipal report, the title report. So, but plan on about 60 days at least, might be a little bit longer. And if you're in a rental, you're not going to give notice to your landlord as soon as you find the house that you're going to be leaving, because your closing date is called on or about. So it's not firm until it is set, but as these benchmarks are met, you kind of have an idea if you're going to be able to make the date that you want. And sometimes people have an expiration on their offer, and that the offer is only good for some period of time. I don't think you'll find that to be very common right now, because if you want the home, you leave your offer on the table. So if it were a buyer's market, then you might have an expiration. But really at this point, sellers are in the driver's seat on those time frames. So as I mentioned, the next step would be, if your offer is accepted, to do your home inspection. The home inspection is to help educate you on the condition of the home. Homeowners are not going to make the home new for us, so it should not be expected that you have a laundry list of things that the homeowner has to do. A lot of buyers are waiving their home inspection. I'm not a fan of that. I think it's really important that you have one and know what you're buying. Will sellers fix some things? They might, but again, probably in this market, not so much, unless it's something that's really a safety issue they would fix for themselves because they're living in the home and they don't know about it, or maybe something that might be required to get the mortgage. But generally, if you pull up to the house and it looks like it needs a new roof and the shingles are curled or missing, plan that into your price. But don't expect, to do a home inspection and then ask and negotiate for a new roof. If you see it, factor that into your offer. So after your home inspection, as I said, is the contract, and then you'll be finalizing the mortgage. That process where you submit all your documents to the bank and underwriting and all. And at the very end, then you're going to need homeowners insurance. That's going to be a condition of every mortgage. And so you're going to pay for the year's worth of homeowners insurance up front. And then in your mortgage, they're going to take 1/12. So when the next year's bill comes due, they pay it for you. Same with your property taxes. As Denise said before, you're going to have to have enough closing costs to cover a year's worth of property taxes up front. Nice thing about both of those things is when you sell, you get that money back. So it's not like an expense as much as it's, it's basically like held for you. So in the future, when you sell, somebody's going to reimburse you, and the money you have in your escrow account will come back to you. You're going to have a final walkthrough. That might be the day of or the day before, a couple of days before, to make sure everything in the home was as it was when you saw it, when you made your offer, had your inspection. If there were repair items, making sure that those things were done. And then you're going to go, the other thing you need to do before you go to the closing is set up all of your utilities, and your agent's going to remind you of these things as that's part of their job to help you, because you may not think about it in terms of now's the time to call Orange and Rockland or Central Hudson and have the electricity put in your name, or the gas service.
And the day before your closing, your attorney will tell you how much the certified check needs to be that you'll need to bring to the closing.
But they do get an estimate before that.
Yes, but the day before the closing, they get the exact figure. But
Right.
you will have the closing disclosure that you receive 3 days prior to your closing, which will show you how much you need also. But your attorney will have an exact figure.
Because they have to make those adjustments for things like taxes, because the seller has paid the taxes for the year, and they get reimbursed for what was left over of the year. So everything is prorated, so you'll get an exact number. But it should never be a surprise. So when you get those closing disclosures from the bank, that's a pretty good idea. It's not exactly how much the check needs to be written for, but you have a general idea. So none of that should be a surprise. So when you have those documents, make sure you look at them very carefully and you ask any questions of the lender when you get it. And at the closing, you sign the note, you get the mortgage, and also closing disclosures and loan estimate.
Yes. So the credit union offers balance to our members for free. The contact information is on this screen to contact balance. They will, they do home ownership counseling, they do student loan coaching, and they also can help you come up with a budget and go over your credit report with you. So it's a really good service that the credit union provides, and I encourage everybody to take advantage of it because it is free to you being a member of the credit union. And you can download a copy of our ebook, The Journey to Homeownership, and the web link is showed right below this slide. And if you guys have any questions, you can put them in our chat screen.
Denise, we do have a couple of questions that have come in already.
Okay.
The first one, Denise, would be for you from Wendy. Do you happen to have with you the income limits in Ulster County? I know you gave the ones for Ulster.
Yeah. Hold on, I gotta find. So Ulster County. So Fannie Mae has two programs. They have the Achieving the Dream, which is their lowest interest rate. So right now that rate is 3.125. And the income limit for that program for a family of 1 or 2 is $70,240. And for a family of 3 or more is $80,770. Then for their low interest rate loan, which you would think would be a lower interest rate, but it's not, the income limit is higher. So for a family of 1 or 2 for Ulster County, it's $87,800. And for a family of 3 or more, it's $100,970 for Ulster County for those two programs. With Fannie Mae, if you go with the down payment assistance, the regular down payment assistance loan, it does bump your rate to get that down payment assistance. But for some people, that is the only way they can get into the house, because, especially in this market, because it's very hard to get a seller's contribution in this market. I think Catherine would agree. So you have a better chance of going with the down payment assistance of 3% instead of bumping the price up to get a seller's contribution, where you're in a competitive market already with multiple offers that typically go over asking price.
Yeah, the seller's contribution, or concession we call it, is not a popular option at this point. You're basically rolling in your closing costs into your financing. It's driving the price up for those closing costs, which it's going to also have to appraise for that. So sellers will often not be interested in that. And there's an interesting thing that I want to say. I see a lot of banks, I see a lot of pre-approvals, and I work with a lot of buyers. And oftentimes buyers will say, well, I went to my bank and this is the pre-approval that I got. But that bank only had certain programs to offer them. And when I see that, I recommend a bank like Mid-Hudson Valley because you have all these programs for first-time home buyers. So, and I don't want to say bad things about any other bank, but when you think I'm going to my bank, your bank may not specialize in the kinds of loan that you really would benefit from. So they may approve you for what they have to offer you. So definitely consider programs like this because it would be to your advantage, especially like that seller's contribution. So if you end up with something like that, you definitely want to shop it around.
Our next question, again, Denise, probably be best for you. The Fannie Mae 3% down program, are buyers allowed to put more than the 3% down for that program?
You can always put more. You just can't put less than the 3% down, but you can always put it down more. The more you put down, the lower your PMI rate is, because your PMI rate is based off of the percent you put down until you get to the 20% down payment, and then there's no longer PMI.
Excellent. And then I'm going to combine, we have two more questions. I'm going to combine them because they're both having to do with credit. And, what is an acceptable credit score for someone looking for a mortgage? A. B, what program might be best suited for someone whose credit is below 700?
So Fannie Mae, which I personally believe is the best first-time home buyer out there for, first-time home buyers, they don't go by credit score, they go by your credit profile. The MI rate is calculated off your credit score still with them, but they look to see that you haven't had any late payments in the last 12 months and that you have at least 3 lines of credit that you've had for 12 months. And it doesn't have to be traditional credit that's on your credit report. It can be alternate credit references like your utility bill, your car insurance, or your rent payment, as long as we can document those items. With rent, if you rent from an individual, we actually have to see those payments coming out of your account or a check clearing your account. They don't accept cash with a receipt from the landlord. Only if you rent from a management company, then they allow a letter from the management company as proof for that credit.
So what were those alternate credit things? Utility bills?
Utility, car insurance, anything you pay on a regular basis. So it could even be daycare. If you pay daycare every month, that you can use as long as you can provide proof that you're making that payment. So it's anything you pay on a regular basis.
Is there a minimum, though, credit score that?
It's not really. Fannie Mae looks to see that you have a 620, but really, if you have a 620 credit score right now with Fannie Mae, you need to put more than 3% down. So it's hard to say that there's a minimum credit score for, any of the other loans, because that credit score kind of gets adjusted by your debt to income ratio and the amount you're putting down for the loan. Thank you everyone for participating in our home buyer seminar tonight.